Dino, why is a private money loan more expensive than a bank loan?
Again, sorry?
Why is private money more expensive than bank money?
Bank money is people's money. So we're heavily regulated, right? Actually, no, let me take that back. That doesn't explain it. Technically, again, like fractional banking, I explained the banking system before, we're lending out customer deposits. Our cost of funds, right? Cost of funds in a bank, in a federally regulated bank, is technically a lot cheaper than a private money, because private money is private, aka private equity, debt funds and stuff like that are all private equity, right? So, now I'm just generalizing, simplifying here. A bank pays out, everybody knows this, how much do banks pay on your deposits and how much are their loans? It's always a huge spread, right? Why? Because theoretically the banks are federally regulated, so you got the federal government watching over your deposits. So your risk is less, so we pay less for that because we have to pay so much in compliance costs, regulatory costs, oversight, all that kind of stuff. So we don't pay out a lot. Our cost of funds using deposits is much less, so we lend it to make the same spread. We don't have to lend it at a high rate. Private money is private equity, right? You go put your money in a bank, for example, let me use this example. You have money to put away, so you park it in the bank, right? And you get 1%. You feel safe, right? Imagine someone came to you, a private equity firm came to you and said, give us your 10,000 and we're gonna hold on to it and then give you a return on it. Where do you feel safer with your money? In a money market savings account at the bank or with a private equity firm, a debt fund? Where would you feel safer?
With the bank.
Right. So the bank pays you less. So for you to use your money, for you to park your money or invest with a private equity fund, instead of putting it in the bank and earning yield, you have to pay for the risk, right? Which is what? A higher return to make you feel better, right? So the cost of funds in private lending, shadow banking, is so much higher than regular banks. So what does that mean? They got to charge more for the loans because they have to return return a yield to their investors that's much higher than if their investors were in a bank earning 1, 2, 3, 4% on savings. Does that make sense? Cost of funds is more expensive in any kind of private money lending or private equity lending than a federally regulated bank. The cost of funds is way more expensive. So in order for them to make the yield, they have to charge you more, right? This simplification, the cost of funds in the bank lending is here, a private equity is here. So they both make the same spread margin. So the bank loan is going to be like here, and the private equity fund, if you need to make that margin, it's going to be like here. That's it.
Got it.
Risk.